If you have just joined us, this is Niaga AWANI with me, Ibrahim Sani. So early on in the day, we were covering some aspects of the developments of the country. Now, we're going to focus a little bit more on a focused interview. Joining us is the Group Chief Executive of Standard Chartered, Bill Winters, here in Kuala Lumpur. Bill, how are you?
I'm very well. Very nice to be here.
First of all, it's a pleasure and an honor and a privilege to be speaking to you. I've been speaking to some of your colleagues, including Abra Anwar and a few other folks over the past few months and weeks. And of course, we want to just pick your brains a little bit into how Standard Chartered is going to develop over the past few years under your leadership since 2015. Of course, we want to also hear about the plans moving forward because, as we all know, monetary policy is tightening around the region, if not the world. We're looking at inflation rates going up in a few markets, especially one in Malaysia. Credit crunch is also looking to be impacting most of the retail customers that you have. So maybe we can dissect the wholesale business, the retail business, and many more. But first, maybe we want to deep dive into, since your appointment from 2015, how has the journey been? It has been 7 years. What are some of the lessons that you've learned, and perhaps some of the direction that you plan to take with Standard Chartered moving forward?
First of all, thanks very much for having me. It's a pleasure being here. As for my 7 years at Standard Chartered, it's been a real adventure. So we came at a time when the bank franchise was very, very strong, but the bank had some problems that we had to work through, and we did. We worked through them, I think, successfully. We repositioned the company for growth, and we're have continued to establish a really good, strong growth platform for the bank. Of course, there have been a few bumps along the road, not least the massive global bump that we've all lived through, which is the pandemic, which certainly has taken its toll on a number of the markets where Standard Chartered operates. And as you know, we've got operations across really almost every part of Asia, Middle East, and Africa, with very important connections through to the Americas and to Europe. So a truly global bank. And the pandemic has hit us sideways. I'm delighted to say, though, as we sit here in July of 2022, that we can begin to imagine the pandemic in the rearview mirror, which is not to say that the disease has gone away, but the really worst of the economic impact does seem to be receding.
I want to also look into some of the economic challenges that is going to face all the banks in the world. We've seen how the record low interest rates have forced banks to perhaps shift how you guys do stuff. We also want to learn more about how the bank is going to move forward, particularly when interest rates are slowly being increasing around the markets, especially that in Malaysia we're seeing clearly some reports of how the Bank Negara, or the central bank, plans to in fact increase it even further in the next MPC meeting. How do you maneuver these kind of challenges and perhaps even further macroeconomic issues like inflation rate that is going to impact most of your retail customers right now? What's the plan and what's the strategy moving forward for Standard Chartered?
So the strategy for us moving forward is a continuation of what we've been doing, but with ever more focus. We're a cross-border global bank, so we serve corporations and their needs primarily as it relates to their cross-border activity, trade, investment, and the like. So we help them manage their currency risk. We help them to manage their cash, very substantial operations in cash management, securities custody, and of course lending. And the like, and that corporate business remains very strong for us. Thankfully, corporate balance sheets are healthy. The global economic activity remains strong, although there's clearly storm clouds gathering as central banks, as you say, raise interest rates in response to higher inflation. But that strategy is very much intact. The other half of our bank is retail. I was delighted to hear that you, in fact, are a retail customer yourself. So you've made a very good choice, and that is that's it's a key business for us. We've have a very clear focus on helping people who have accumulated some savings to invest those savings to manage their finances. But we've also got a very strong personal segment or mass market business that's particularly focused on delivering an excellent digital offering, which we're often doing in partnership with either technology companies or e-commerce companies in local markets, increasingly, in addition to our very substantial branch network. So that strategy is intact. like the effect of zero interest rates during the COVID period was very painful for us, as it was for, I think, almost every bank that has deposits in countries that adopted a very low interest rate policy. It was the necessary thing to do. It's now appropriate, given higher inflation, for central banks to send interest rates at least back to normal. So at least back to, in the US, back to that 2.5% to 3% sort of neutral level. Now, perhaps they'll need to go further to contain inflation. But this, of course, is also a double-edged sword. On the one hand, we expect our profits to increase very materially on the back of higher interest rates. On the other hand, we know that the cost of living crisis that inflation brings is both bad for our customers and bad for overall economic activity. And we know that there's every possibility that the way for central banks to contain inflation is effectively to initiate a recession. And while I think there's a reasonably high likelihood that the US and Europe experience some sort of recession over the next year or so, I'm very hopeful that recession will be a relatively shallow and relatively short recession. And the reason I'm hopeful is that, number one, corporate and individual balance sheets are in good shape. So the consumer is not overextended right now, certainly in the markets where we operate. And corporations have taken advantage of very low interest rates to term out their debt and effectively fix their interest rates at lower levels. So I think that the strength of the borrower sector will be helpful, and also the strength of the banking system. Banks pretty much everywhere in the world are very strong right now. This is obviously following the reforms in the wake of the great financial crisis. So bank capital positions, the bank cash positions, liquidity are good and strong. And that bodes well for acting as a bit of a shock absorber to the economic cycle, as interest rates could and almost certainly will reduce economic activity substantially. So possibility of a recession, but we hope narrow and short. Good underlying momentum in our business. So our strategy is full speed ahead. We haven't pulled back on our investments at all. We're not withdrawing from customers at all. In fact, we're very, very focused on helping our customers to navigate through some pretty tricky waters that we're all sailing through right now, on the back of higher interest rates, higher cost of living, and some economic pressures.
The last time your colleague, Malaysia CEO Abra, came on the show, we were talking about little things about how culture is being developed across companies. I want to learn a little bit about how, because of the new normal that you guys are doing right now, the culture that you want to instill upon the company that you're leading right now across the various markets, how is that being done? I'm pretty sure that's a bit of a challenge, don't you think?
Culture, I think, is always a challenge, and as we all know, if you don't get the culture right, it's very hard to get the strategy right or to execute that strategy. I'm very fortunate to have joined a company with a very strong culture, and that culture, it was one that is fundamentally one rooted in the local communities in which we operate. So, very strong sense of what's right and wrong. The tagline for Standard Chartered Bank is "Here for Good." Which before I joined the bank, I thought was a very nice 3 words. I came to understand that actually is the ethos of the company. We try to do the right thing, and we try to do it in an enduring way. So for good. But that in and of itself is not enough to generate really successful outcomes for our customers and for ourselves. We also need to have a very strong culture of performance. We need to have a very strong culture of innovation. And we've done a lot of work, certainly in my time in the bank, to make each of those things even stronger than they were. So we know that banks like Standard Chartered, we introduced the first cash machine, the first ATM in Asia back 50 years ago.
No way.
Yeah, we did. And in Hong Kong, and then in Singapore, and then in Kuala Lumpur. And this that kind of innovation is in the blood of Standard Chartered. And of course, we're trying to apply that in the new world, and we've done that. We have the leading digital bank that was built in Hong Kong. We're rolling out that same technology in Singapore. We've got 9 digital banks, so digital only banks in Africa. And they're continuing. I mean, there's many examples of innovative types of things that we're doing, and this is really good. The key is to make that ongoing change, that ongoing innovative process, a core part of the culture of the bank. And I think we're getting there bit by bit, but there's
Yeah.
always more that we can do.
The issue here is, of course, competition. Competition is going to be strife. You're not just competing against the traditional banks right now on the digital platform. You're competing against digital players that are not banks. Digital wallets, of course, with the digital banking license, at least here in Malaysia, and some of the markets that you're operating out of Asia, particularly Southeast Asia. Some of your competitors are even merging, amalgamating, being acquired. Things are rough, yeah, for the banking industry. How do you plan to proceed in terms of this tightened or rough competition that is dotting the landscape right now?
Look, banking has always been competitive because everybody uses banks one way or another, so it's a huge market, and banks, certainly through cycles, banks that do well generate decent returns, as we are generating ourselves. How do we compete? We compete by focusing first and foremost on the customer, and we can take on any bank competitor or any non-bank competitor if we focus first and foremost on the customer. Now, in many cases, for us, that means building our own sets of products and services and delivering those to our customers. But in many cases, other cases, that means partnering with this very same people who might otherwise compete with us. So we're just launching now what I think will be a very exciting partnership with Bukalapak in Indonesia, where we're offering a full range of banking products through the Bukalapak e-commerce sites. And now they might have chosen to compete with us, and other e-commerce platforms do compete with banks. In this case, we've chosen to partner with an e-commerce platform because we think that's the best way to provide an exceptional delivery channel, delivery mechanism, and set of products and services to Bukalapak customers, who will then become our customers. We've got dozens of examples of those kinds of partnerships. And I think we've partnered now with over 200 Fintech companies. Sometimes they help us build our applications. Sometimes they help us deliver product. Sometimes they're helping with our digital marketing. But in every case, these are partnerships. And these are people that in another life or in another form may have competed with us or tried to take away bits or pieces of our client relationship. But by partnering, we can actually deliver a better set of products and services, often more quickly and more cheaply.
All right. Bill, I will go for one more short break. When we come back, we'll discuss a little bit more about the global landscape. We'll be right back after these messages. Thanks for staying on. I have with me on the line Bill Winters, the Group Chief Executive of Standard Chartered. Bill, we have to talk about the Russian-Ukraine war. It is a war. I refuse to say anything other than that. There's also that whole notion of how this war has escalated beyond the timeline that President Vladimir Putin thought it would be. And it has conjured up strange economic impact. Euro and dollar parity, that's for one. Nord Stream 1 being shut down right now as we speak and has created some sort of nervousness in Germany and beyond. How do you think this is going to pan out, and how does this impact the global economic recovery towards life after the pandemic?
Yeah, it is a truly horrific war, and I'm afraid, of course, I'm not a military expert, but I'm afraid that every indication is that it's a war that will carry on for some time. So the base case has to be that this is a war of attrition, that there will be a steady escalation of sanctions against the Russians or actions that the Russians take, which probably means an ongoing disruption to, in particular, energy flows out of Russia, which of course is feeding into the inflation trends globally. So while Standard Chartered Bank doesn't have a business in Russia or Ukraine or elsewhere in Eastern Europe of any huge note, so the first order consequences for us are not so severe. The second order consequences for the world are quite substantial in terms of inflation, in terms of a search for a new form of energy security. And I think the implications for the global economy are very substantial. I think it certainly increases the likelihood that Europe falls into recession in the latter part of this year or the early part of next year. I don't think in and of itself it adds hugely to the the recession risk in the U.S. Although, as we've discussed, the reaction to inflation could also drive recession in the U.S. And maybe as important as the shorter term inflationary and economic impact, it's the reconfiguring of corporate and individual energy supply chains that will have a profound impact for years to come. And one of the questions that comes up regularly now is this going to help or hurt in our transition to a low carbon economy, which is a key area of focus for Standard Chartered, as I know it is for you and most of your listeners.
Yeah.
And our assessment is that in the short term, it's probably a negative because as corporate balance sheets and government balance sheets are squeezed as a result of the effects of this war, amongst everything else that's going on, the focus on the margin around those very substantial investments that we need to make to transition to a zero carbon economy, those investments are going slower. In the medium to longer term, I'd like to think that it's a positive because of the focus on energy security, the focus on diversification of supply of energy, and the structurally higher energy prices will drive investment into renewables and into alternative sources of power. And that I hope we can capture if there's any silver lining in this war at all, and I'm not sure yet that there is any silver lining. I hope it would be a focus on finding new renewable clean power sources that could help advance our migration to a zero carbon economy.
Now, of course, banks or financial institutions may have little or low impact towards carbon emissions, but of course you finance many of the companies that actually do have high impact. So the notion of banks having a direct impact towards ESG is actually quite crucial. Environmental aspect, of course, governance is a big issue, not just in this part of the world, but across the world. The banking sector has faced a lot of or numerous challenges when it comes to governance. How does the bank or Standard Chartered in this case position yourself towards ESG and of course diversity, equity and inclusion as well? Perhaps, Bill, you can share with us some of that ideas that Standard Chartered is doing right now.
Well, we try to position ourselves, and I think we've succeeded in positioning ourselves as real leaders in this space for a few reasons. One is the markets where we operate across Africa, Middle East, and all of Asia will be the most affected markets, most affected economies and societies as a result of rising temperatures. So whether it's the heat that we saw as recently as a month ago in India, with 15 days over 50 degrees centigrade in Delhi and surrounding areas, or the number of coastal cities in which we operate are very substantial operations in countries like Bangladesh, we know that our markets will be most affected if we can't avoid this increase in temperatures. We're already seeing some of that. On the other hand, we know that the financing gap that exists between that which we know needs to happen and that which we know can be financed is biggest in the emerging economies in which we operate. So when we look across Europe today, for example, we can see that maybe 60-70% of the financing that's required for corporations to transition to a low or zero carbon economy, it's pretty clear where that's going to come from in most cases. If you go to sub-Saharan Africa, where we operate across the continent, the available financing is less than 10% of what's required. And the amount that's required, we're talking about here, is in emerging markets is $3.5 to $4 trillion per annum, right? So where's that money going to come from? The good news is the money's there. At least a chunk of the money is there in all these ESG funds that have been set up that are very focused on sustainable investing. The bad news is they have a lot of trouble getting that money deployed into the areas where they can make the most difference, i.e. the markets where Standard Chartered operates. So we set up an entire business of providing our own capital, but also other people's capital, including the multilateral development banks, export credit agencies, to package up these financing packages to deliver to these developing economies where the impact is the greatest and where the need is the greatest. That's a big business for us. It's also an obligation for us to deliver that set of capabilities, products and services and financing in order to effect this transition to a zero carbon economy. And we are absolutely playing a leading role in that.
Could you explain a little bit further in terms of how the redeployment of capital into ESG activities is going to be done? Is it in stages? Is there a number that you can share with us? Are there entities that you're working with?
Yeah. So what we've said is that just for starters, we will channel $300 billion of our own money and then third-party investors into sustainable financing product over the next 5 years. And we're well on track to deliver that. In fact, we can expect to continually revise up that projection as we go through time, because there is a wall of money looking to invest in the right things, but that money is finding it difficult. Those institutional asset managers, insurance companies, many banks are finding it difficult to pull that together into projects that make economic sense from a risk and return perspective. So we have a business in sustainable financing. We've set a target for ourselves of earning $1 billion of income in that business in the next several years. My expectation is that we will far exceed that outcome. We've been doubling this business year over year for the past several years, and we'll continue to. So it's a business for us, is also an obligation, and the numbers that we're talking about are substantial. We're obviously just one bank, but if we can catalyze some of our efforts into mobilizing these large swathes of money from across the banking and institutional investing community, we can begin to really make a dent in the massive problem that we have as a planet.
Now, we've discussed a little bit about the macro developments right now, but I just want to circle back to the bank itself. There are plenty of regions that you guys are actually operating out of. Of course, this might spread your resources a bit too thin. Where would be some of the key markets that you're planning to deep dive next? And you feel that digital banking is going to be a key feature, knowing that you guys are going for full digital banking in Hong Kong and Singapore. Is that model going to be replicated in markets elsewhere?
Look, the core markets for Standard Chartered, the biggest markets for us, we're present in every ASEAN country. ASEAN is extremely important for us. This region is in many ways is our home. Our operational control center is based in Kuala Lumpur. Many of our operational leads and business leads are based in Singapore. Our biggest single market in the group is Hong Kong, and China is our fastest growing market. China and Hong Kong are becoming ever more interlinked as China opens up its capital markets and as the RMB internationalizes. That's being done to a very substantial degree, in and through Hong Kong. So that this Asian region is absolutely central to us. It remains the primary area of focus and investment, just given the size of Asia broadly defined to our group. India is very exciting. We've been in India for 160 years. We're solidly profitable and growing very nicely in India. And I think the Indian economy feels very healthy right now, despite all the global challenges that we face. India is also our operational hub. We have about 30,000, 25,000 people in total in India. In terms of new growth opportunities, last year we opened up a new bank in Saudi Arabia. Next year we'll open up a new bank in Egypt. So becoming deeper and more broadly based across the Middle East and Africa. These are extremely important investments for us in fast growth parts of the world. Of course, each facing their developmental challenges, but we feel very well placed, having operated in the Middle East for well over 100 years. And we continue to invest in digitization across all of our markets. So digital banks that we've launched now in Africa, across 9 markets, are continuing to grow. We'll continue to build those out. And maybe final comment, Europe and Americas are very important for our group as well. So a little bit over a third of the income that we generate in our corporate bank, which is half of the group, come from European and American companies. For the most part, those companies are interested in our products and services in Asia, Middle East, and Africa. So we're creating this network effect that is at the core of our value proposition. So Europe and America is growing very fast for us, but leveraging entirely the capabilities that we have back in this part of the world.
Of course, the Chinese markets have been underperforming global markets for the past 12 months. Do you think that markets have bottomed out, and has this impacted your business?
I think China went through some pretty wrenching changes, most recently, obviously, around the COVID lockdowns. But before that, pretty seismic shifts in regulatory posture vis-a-vis technology companies, and some particular liquidity type squeeze on the back of policy changes at the government level, in particular in the property sector. So the Chinese markets have been through a real roller coaster. What we've seen over the past couple of months, obviously, is maybe the beginning of some easing in the COVID restrictions, although I know it's too early to call an end to that because this pandemic is still raging, or at least threatening China, as it is the rest of the world. But we saw a little bit of repositioning in terms of regulatory posture, a little bit of shifting of focus back towards economic growth and away from some of the broader prosperity type objectives of the leadership. That has resulted in quite a nice bounce back in the equity markets. But from our perspective as a bank operating extensively in and around China, we've seen a really steady flow of investment both into China, but also coming out of China. We've seen a consistent opening up of the capital markets and of the internationalization of the RMB. We think that those trends are inexorable. And if that continues to be combined with a pro-growth, call it reform-oriented economic policy, and we'll see how that shapes up over the coming months, I think China has a very strong runway of growth in the years to come. And in fact, we're reasonably confident that will be the case, which is why we were clear in the commitments that we made earlier this year that we would be doubling down our investment in China, so substantially stepping up the pace of our investment in China, because we see China as we think China has a foundation of underlying growth, which will resume as we come out of this pandemic period, and an ongoing internationalization of the RMB, which plays to our core strengths as a bank, which are to provide these cross-border services in every regard.
All right, final question, Bill. We want to talk a little bit more about your own plans. What's next for you, Mr. Winters himself?
Well, what's in the immediate future for me is to deliver the commitments that I've made to our shareholders around the achievement of a set of strategic and financial objectives for Standard Chartered. We committed to deliver a 10% return on tangible equity to our shareholders by 2024. I qualified that a bit in the first quarter to say, if not earlier. And we acknowledge that the if not earlier part in particular will be a function of the evolution of interest rates coming out of the and elsewhere. But the interest rate increases that the market has been expecting are helpful to us. Our business remains very strong, and I'm confident that we can deliver on those financial commitments that we've made. From there, I want to complete this strategy, continue to work at the behest of our shareholders and our board of directors, and we'll take it from there.
Fantastic. That was Bill Winters, the Group Chief Executive of Standard Chartered. Bill, it has been an honor and privilege to speak with you. Hopefully we can do this a little bit more often. Of course, if you've missed any part of this interview, just head on to astroawani.com. Look for Standard Chartered. There are plenty of resources and interviews like this that can be found there. Bill, thanks again for joining us.
Thanks to you.